Hey everyone, in today's video, I'm going to be talking about 12 Canadian Dividend King stocks to consider buying. Now, unlike the US where they have tons of these Dividend King stocks that are characterized as increasing their dividends for 50 plus years, we don't exactly have the same array of 50 plus years dividend growth stocks. So I've just looked at Canadian dividend stocks who've grown their dividends for a very long time, some of them 20 years, some of them 30 years. Some of them on this list is actually 50 years plus. So we're going to go through them one by one. The objective of the video is hopefully tip you off to a couple potential investment opportunities that you guys want to add to your watch list. Do some more research for the portion of your portfolio that you may want to get exposure to dividend growth stocks over time. The great thing about dividend growth stocks is in addition to the yield you're getting, obviously year over year, you're going to continue to get raises. You're going to continue to build that dividend snowball, and that growth's really going to compound, especially on some of these companies that have high return on equity. They can invest the money better internally than they could externally, than you could externally if they had that as part of a higher dividend yield. So it's really the best case solution for a 10, 20, 25 year investment horizon to have these companies compounding that cash flow internally and then just continuing to give you some of that return year over year over year. So if you like this kind of content, before getting into it, be sure to give this video a big thumbs up. And if you're not, please consider subscribing to the channel. Would really appreciate that. We're just going to jump right into it now. Thanks for sticking with me through that intro. But the first Canadian Dividend King stock is Saputo. So Saputo, let's just take a look at their performance in the past year, obviously down there 13%. Down pretty big at 25% in the last 5 years. This is a $12 billion company. So a pretty good sized company, currently paying a 2.6% starting yield. So some of you may know what this company does, but for those of you who don't, we'll go through some slides. First of all, we'll just go through some of their geographical mix. And this is just a dairy company. We'll get into that in a second. But I didn't know how diversified this company was. About half of their revenue coming from the US, as you can see here, about a quarter from Canada, and then a quarter from international and Europe combined, which was really interesting to see. In terms of product mix, we'll get through it on the next slide, but they sell cheese, dairy foods, milks, some non-dairy products, but that's a very small part of the mix. It's really dairy foods and cheese, which is about 80% of their business. And you can see they have some volatility in terms of net earnings and cash flow from 21 to 22 to 23, but their revenues have been pretty consistently going up over the short term. A bit more about their geography here that we just saw. You can kind of see what they're kind of known for and what they're trying to accomplish in each of the regions that they operate in. So one of their international divisions, Argentina, they're the top dairy processor. Australia, a leading dairy processor. Canada, leading cheese manufacturer, milk and cream. And then one of the top 3 cheese producers in the US there. In terms of their mix of business, this was really interesting to me. They actually operate across retail, food service, and industrial. So retail is obviously when you're going to the store, about 50% of their revenue is coming from just buying products in grocery stores and doing direct-to-consumer purchases. A third is food service, so they're selling to distributors, they're selling directly to restaurants, their cheese and milk type products. And then the last 20% is industrial. So manufacturers who are using their products to produce other products. So maybe like a food company, I'm thinking off the top of my head here, but like a dessert company or a snack company that needs milk or cheese in the products that they're ultimately selling to consumers. They sell essentially wholesale to them as a revenue division. And then their mix of business from a product standpoint. So about 50% of the business is in cheese here, 30% in dairy, 10% milk. So they're pretty well diversified. And for a company that's increased their dividends for such a long time, that's usually a common theme that we'll see throughout this video. They don't have cyclical businesses that can get disrupted by one event or commoditized in one area and one region, because over decades it's kind of prone that something may happen that's bad or a recession may happen. They may not be able to continue to increase their dividend. So these companies who've increased their dividend for decades and decades, it's really a testament to how well diversified and and relatively safe for an equity position that they are in the grand scheme of things. And this is just their dividend back from 1998. So this is just phenomenal dividend compounding and dividend growth. You can see here in 1998, their dividend was just a couple cents a share per year here, and all the way up very quickly has ramped up even through 07, 08, 09, which was a tough financial time. And even more so lately, we're all the way up to 72 cents a year, all the way up from where we were here, which is about 3-4 cents a year. So this just goes to show if you were holding onto the stock back here, where the stock was paying out about a 20 cent a year dividend annually, that was only 13 years ago. The dividend has 350% growth since then. So a really strong dividend growth CAGR. They're in really strong positions on lots of their businesses. So that's a great sign when they're the market leaders and whatnot. When we were looking at that chart over here, they have really good market positions. They're operating all over the world for the most part. So great business that they're running here. In terms of their valuation, currently trading at about $1.80 a share. So that's probably about a high teens multiple. Next year, expecting to do about $2.20, which would be about a 13 to 14 times multiple. So reasonable valuation. Some earnings choppiness in this one. Lots of exposure to restaurants through food service, as well as the consumer through retail. So you have to gauge those risks, but it's not trading at too expensive a valuation, especially for the dividend track record that they have on this company. So an interesting one there that I haven't really looked into too much before, but it was interesting looking through Saputo for the first time. The second Canadian Dividend King stock is Metro. So Metro is a grocery chain. See here, a bit smaller starting yield, about 1.7%. Similar size company in the teens, billions, 16 to 17 billion dollar market cap. Over the last year, it's about flat. Over the last 5 years, the company's done really well, up almost 80%. Looking at their business a bit, really strong growth rates here. Sales CAGR, 7% a year on average over the last 5 years. EPS up 12%, so almost doubled sales CAGR. So they've been pulling out a lot of efficiencies and synergies in their business. For those of you who don't know, Metro actually also owns tons of other banners. Just to scroll up to show you guys on the bottom here. But they recently acquired Jean Coutu a handful of years ago. They own Food Basics, which is their discount banner, Super C in Quebec, Brunet in Quebec too, I believe. So they own a bunch of banners. They're really overdeveloped in Quebec because I think that's where the company's initially from. You can see the cash flow generation here, which obviously when you have a dividend growth stock and a strong dividend stock, it's underpinned by the cash flows of the company to be able to sustainably pay out those dividends. So you can kind of see here, 15 to 19, they're sustainably earning about $700 million of free cash flow annually. You can see it went all the way up, pretty much 50-60% growth overnight during the pandemic. Went up a bit farther from that, and now it's correcting a bit down. But still, if you were to look at 2022 versus 2019, the business is hugely larger now, doing over $1 billion of free cash flow generation on an annual basis, which really helps increase that dividend CAGR as long as they can hold it up. And talking about the dividend CAGR, you can see similar to Saputo, really, really strong growth here. You can see the payout ratio is only 30 to 40% of net earnings, and it's gone from a cent in 1995 and 1996 all the way up to over $1 in 2022. So that's a 100 times increase in about 30 years. If we wanted to look at a shorter time frame, from 2013, the dividends more than 300% gained in the last not even decade. So really phenomenal dividend growth on this one. 19% CAGR over 27 years, which is really phenomenal for this company here. In terms of their earnings per share, expected to do about $4.60 here. So trading right around 20 times current year, or no, not 20 times, right around closer to, I'm just doing math in my head, 16-ish times, 15, 16 times earnings on Metro. So for a company that's have had a dividend growth rate like this and revenue growth like we saw on that first slide here, in terms of 7% CAGRs on sales, 12% on EPS. I think that's a pretty fair valuation for the stock, similar to Saputo, trading in that kind of mid-teens range on this one. Going into the next one, very different industry here, Canadian Natural Resources, much bigger company, $90 billion here, and a bigger starting yield at 4.3%. See here over the last year with kind of commodities going up, this one's up 20%. In the last 5 years, up 100%. So this one's done really well, even without the dividend payout. Looking at the business here, just so you get a sense of what kind of operations they have exposure to: natural gas, oil, light oil, SCO, and then they operate in North America, North Sea, off the shore of Africa, things like that. You can pause this video if you want to read a bit more on Canadian Natural Resources. But what I really wanted to get to is just their dividend growth. You can see here, even in the last 5 years, they were paying 33 cents a share in 18, 37 cents a share in 19, 42 cents a share in 20, 47 in 21. That went all the way up to 75 for the most part. It looks like a special dividend there, but 75 in 22, and then all the way up to 90 in 23. So in 5 years, they've gone from paying 33 cents a share all the way up to 90 cents a share, almost a 300% increase over 5 years. Just absolutely insane, like a 50% a year dividend CAGR pretty much on Canadian Natural Resources here. Looking at their earnings, so they're expected to do $7 this year, which is about 12 times earnings, $8.50 next year, which would put them at about 10 times forward earnings on this one. Obviously a more commoditized market, a bit more cyclical here, so that may be factored into the valuation a bit since they're at a high right now in terms of earnings potential, but relatively low PE versus some of the other Dividend King stocks we're going to be talking about today. Okay, Canadian Utilities. So this is one of the true globally recognized Dividend Kings that we have in the Canadian market. Obviously not having a day today, down 15% over the last 6 months here. You get a starting yield of almost 6% on this guy. So really strong starting yield. You're right at the bottom of the 52-week range. Even if I put a 5-year on it, you're probably right there right now at the bottom of the 5-year, with the exception of a few days, literally 5 years ago. So interesting time to be looking at this stock, $8 billion valuation. Looking at the dividend history, this one is crazy. You can go back all the way to 1972. It was paying 6 cents a share on an annualized basis. Now it's paying $1.70. So don't even want to try doing the math on that, but it's about 30 times over that 50-year period. Let's pick a bit more of a reasonable time frame, though. So even if I was to look at like 2013 to now, or 2013 to 2021, since that's the date I have here. So over that 8-year span, the dividend went from 97 cents to $1.76. So increased about 80% over 8 years, almost a 10% dividend CAGR over that time period. In the last few years, they've struggled with interest rates being as high as they are, with the amount of debt that these utility companies have. So they've been doing these like 1-2% dividend increases just to keep the streak alive and get through this painful time. But longer term, you can see they've been able to really compound cash inside the company well, feed that dividend per share to shareholders year over year over year. And over 50 years, there's so many recessions, so many of these time periods that we get high inflation and stuff like that. And they've just been able to get past it every time. You can see here in the early 90s, they went from 35 cents to 35.5 cents to 36 to 36.5. So it was a time period that they were doing these 1% raises every year, just getting through a tough time. And then it reaccelerated again. And next thing you know, we're going 70 or 65 to 70 to 75 to 80 to 90 to $1. And now we're all the way up to $1.80. So it's times like this that the market slows down because of whatever variables are going on. But Canadian Utility Limited has really proven themselves to be able to get through everything over the last 50 years and continue to increase that dividend just at different rates during different times. But overall, it's been really, really impressive. Looking at the valuation for Canadian Utilities here, expected to do about $2.30 next year. So trading right around 14-ish times earnings on this one, and paying out most of those earnings via dividend with that 6% starting yield. So really attractive starting yield, but obviously some fundamental elements of this company with the amount of debt they have and the places they play in that you'd want to evaluate and go in eyes open at this point if looking at Canadian utilities. Okay, going to the next Canadian Dividend King stock. It is Canadian Western Bank. So Canadian Western Bank on the year is actually up 16%. Over the last 5 years, down 16%, paying a nice 4.6% starting dividend, PE under 10. Really small market cap there at 2.7%. For those of you who aren't familiar with Canadian Western Bank, I wasn't overly familiar with them, but they're essentially a full-service bank that is catered to the niche of business owners in Canada. So they have more business clients that are using the bank. They have a presence all over the Canadian market. They kind of showed this chart here where they obviously started out west, given their name's Canadian Western Bank, but they've been moving into Ontario really aggressively. You can see here Ontario grew really quickly, about 11%, and they have some exposure in other provinces, but they're mostly out west and now Ontario, given the size of that market. And looking at their dividend growth history, you can see here, just going back 12 years, 19 cents a share back in 2011. You can see they've just increased it like 5% a year with that dividend, that penny dividend raise every year. And you see a bit of back and forth because I think the last quarter of the year they give a bit of a top up on the dividend typically, but you can pretty much see every year going up 1 to 2%. And now we are 12 years later, that 19-cent dividend is now 33 cents. So pretty decent dividend growth record there, especially for having a starting yield north of 4.5% to begin with before you even get any of those dividend raises. In terms of their earnings per share, about $3.50 this year is their EPS estimate, so trading about 8 times earnings, closer to 7.5 times next year. So these smaller, more niche banks may be a bit more risky, and that's why their earnings multiples are a bit lower than like a TD Bank or a Royal Bank. So interesting one to consider depending on what you're looking to invest in the banking sector. Moving on to Fortis. So Fortis I've talked about a lot on this channel. I actually own Fortis in a handful of my accounts. This is a regulated utility company, operates in Canada, the US, even some areas of the Caribbean. Starting yield 4.3%. They've done a really good job of increasing their dividend yield at a really steady pace. So 4 to 6% annual dividend growth, and they've guided that to 2027. If I go back 5 years, they tend to increase the dividend about 6% a year since I've owned this stock. So I expect that to continue based off of the guidance that they've given out and their ability to deliver on the prior guidance. Even though they've gone through a lot of hardships and interest rates going up and stuff like that, they've still been increasing around 6% a year. This one is about to join Canadian Utilities as a dividend king. 49 years of consecutive dividend increases. So we're going to get the next one either later this year or early next year. I think I forget exactly the quarter they tend to increase, but that will be quite a celebratory moment for Fortis, who's really just done a tremendous job of building their dividend yield or yield on cost for investors who got in early over the decade. So congrats to them. On to the next stock. So this stock used to be labeled as Ritchie Bros Auctioneers, I believe. Now they go by RB Global. Company has a small dividend yield, 1.7%. In terms of the dividend or what the stock does, RB Global or Ritchie Bros Auctioneers rents out or sells out used equipment, think like Caterpillar equipment, construction equipment, farming equipment, forestry equipment, and whatnot. They host auctions, they sell, they buy, they kind of transact in that space, which is like a really interesting business to be in, especially on the auctioning side, and be able to increase your dividend so frequently. Just because I think that would be a more cyclical type business, but it appears whatever business model they're running is pretty recurring, pretty sustainable, and they continue to grow their profitability and their dividend payouts. So looking at their payouts, 2011 was about 11 cents a share. We see some pretty nice increases here, up 9% in 2012, up again here 8%. A couple quarters later, up another 6%, then up another 11%. Now we're at the point that we're doing 27-cent quarterly dividends, so over 100% gain in just the last 11, 12 years on this one as well. So really strong performance there. About to do $3.30 this year. So trade, that's about a 25 times multiple. For next year at $4, it's about a 21, 22 times. So I don't know this space very well, so I'm not interested in this stock at all. Also trades at a pretty rich multiple for the type of business it is. I wouldn't think these businesses have high moats and somewhat commoditized and stuff like that. But it seems like they've been able to create a lot of shareholder value over the years. So I'm probably just not too familiar with the company. If you know more about the company, I'd love to hear in the comments. Please share it with the broader group. Just a reminder here as we get to the middle of the video, if you haven't yet, be sure to hit the thumbs up button. It really does help with the channel and then the YouTube algorithm. My videos don't naturally get out to too many people just because of the size of the channel, so I'd really appreciate it. Okay, the next one I have here is Empire Company. So Empire Company, another grocer in Canada, 2% dividend yield. 2% dividend yield, $9 billion market cap on this one, trading right in the middle of its 52-week range. In terms of the brands that Empire owns, we were talking about how Metro and Jean Coutu, some of those other banners. Empire owns a ton of banners as well. Safeway, Longo's, 51%, I think. Farm Boy, Foodland, a lot of IGA stores. Freshco's their discount banner that goes up against Food Basics. Lawdens, it goes on and on. So they own a ton of these retail businesses. They also own 40% of Crombie REIT, which provides them with a lot of stable cash flow on a monthly basis for the underlying real estate that they primarily operate their businesses out of. In terms of their dividend growth, you can see here in the top right-hand corner, even over the last 5-6 years, they've been buying back a lot of shares, but despite buying back shares, they're still paying out more in dividends. So in addition to the absolute growth of these dividends being, 4 or 5% year over year, you're actually getting a higher dividend raise than that because they have less shares outstanding. So these are looking like high single digit, low double digit dividend increases year over year for shareholders of Empire. We're going to take a closer look here. You can see back in 2003, so 20 years ago, just doing a longer view, they were paying about 2.7 cents a share. You can see as I scroll up how quickly they were increasing that. Just 5 years later, it was almost double at 5 cents a share. Then from 2006 or 2007 at 5 cents a share, we get all the way up to 7.5 cents a share. So another 50% gain from 2007 to 2011. And then in the last 12 years here, we've gone from 7.5 cents a share all the way up to 16 cents a share. So in the last decade plus, the dividends doubled again. Overall, over 20 years, going from 2.5 cents a share to over 16 cents a share. It's 500% gain. So they've done really phenomenal on the dividend growth as well. In terms of valuation, going to do about $3.30 next year. So trading at about 12 times. Looks a bit cheaper than Metro, which was interesting. So we'll see what one performs better. Metro did have really strong growth that they shared both on top line and even more impressive on bottom line. And I think Metro called out EPS for long-term forecast growth of 8 to 10%, which is unbelievable for a retailer. Okay, going into the next Canadian Dividend King stock, it is Canadian National Railway. While Canadian National Railway has not been public for 50 years, so it hasn't increased its dividend for 50 years, I kind of count it as a Dividend King because they've increased their dividend every single year since they went public. I think it's about 30 years ago or so. So they've also increased their dividend to a really high CAGR, which is great to see. So the company is about flat year to date. It's gone under some pressure as of late as well. But looking into their business a bit, they own a really great rail network. Goes from west side of Canada to east side of Canada, and then also goes all the way down through the US. So you can get a sense of their business mix here. Very diversified business. Not surprising that they've been able to continue to grow profitability with the moat that they have and how diversified their business mix is. They operate in automotive, coal, intermodal, international intermodal, grain and fertilizer, petroleum, chemicals, forest products, metals. It goes on. And whenever one area of the economy is down, another area may be up and whatnot. So lots of vectors of growth that they can source from. They also own a lot of ports. I think they own 7 ports coming in and out of the continent that are huge revenue and profit drivers for the company as well. As we look at their total shareholder returns here, you can see on the left-hand side, they've increased their dividend 27 straight years, every single year since the IPO. And the average growth rate has been 15% since 1996. So double-digit dividend growth CAGR over a 27-year period is extremely impressive. And at that, they're still only paying out about 40% of their earnings. So it's not like they're just increasing the amount to an unsustainable level of what the payout ratio it is. They still have tons of free cash flow remaining in the company to invest in high ROI opportunities that can increase the dividend for years to come on this one. In addition to dividend growth, they also buy back tons of shares. And I think that's also been one of the drivers that have helped them increase their dividend to the extent that they have, because with a lower share count, even if they're paying out the same amount, it looks like, or it ends up being more on a per share basis. So you saw the company's worth was $100 billion today in Canadian dollars. They've bought back $30 billion of the company since 2000. So lots of incremental ownership in the company going back to the shareholders through that allocation of capital. And they currently have a huge buyback program going on as well of about 32 million shares. That makes up for about 5%, give or take, of the company that they're looking at potentially buying back this year, depending on the price. Looking at the price to earnings here. So just going to the analyst EPS estimates on Yahoo Finance. And it is expected to be about $7.40 this year. So trading right at 20 times. But for next year at $8.30, they're trading at about a 16.5 times earnings for next year if this number comes to fruition, which would probably be the cheapest I've seen CN Rail trade if this actually actualizes. So really interesting valuation on that one. Given the moat they have, no one's building new railways. They've performed really well, increases their dividend every year. Really hard to disrupt that business. Okay, moving on to the next Dividend King stock in the Canadian market. It is Finning International. Finning International, about $6 billion company, 2.5% dividend yield. Looking at their performance over the last 5 years, up about 29%, which is pretty good given the fact that they've been paying a growing dividend along with that capital appreciation. So what does this business do? I myself wasn't too sure what they did, but they're actually a huge dealer of Caterpillar products. So once again, construction, stuff like that. Didn't know it was so many of these companies and such large size businesses in Canada. But then when I looked at this company, I saw that while Canada's half the business, they have a huge operation in South America, big operation in UK and Ireland. So it's not just a Canadian company necessarily. You get a sense of where their revenues are coming from here. Sale of new equipment is a third of the business. Supporting products is over half the business. So that's, I guess, fixing products or parts and whatnot. And then it's little tiny things there like used equipment sales, rentals. But pretty much it's all supporting existing products and selling new equipment is about 90% of the business there. Looking at a bit more about what they do here, just because I wasn't familiar, you can kind of get a sense from this page on the type of products that they're selling. So bulldozers and stuff like that. I'm not in the construction industry, so I'm not going to try to name every single one of these, or I guess it's naming it for me there, the excavators, the compact track loader, and whatnot. But these are the types of products that they're getting at wholesale, I guess, and then selling to retail and then servicing them as well. In terms of their dividend growth, you can see here, we're going to start in the year 2000. It's about 10 cents a year in dividends, and you can just see that grow so quickly, 10 cents to 20 cents, doubling it in 4 years. Then 20 cents to over 40 cents in another 4 years. Then 40 cents to 80 cents. That one took a bit longer, but still really strong growth here. And today it looks like they're paying out about $1 a share in 2023. So we've got a 10x dividend growth rate from the year 2001 when they started increasing their dividend to 2023, over 22 years, up 1,000%, which is really awesome to see. In terms of their earnings here, expected to do about $4 a share next year, trading right at 10 times earnings on this guy. Once again, don't have a strong thought or opinion. Just naturally, this seems like a better deal than Richie Bros, Auctioneers, or RB Global as they go by now, just on the sheer price to earnings ratio. But I transparently don't have great insight into this industry or these businesses, so I'm just evaluating from bird's eye view here. Next dividend king stock in Canada, Enbridge. Enbridge is a huge Canadian company, about $100 billion there. See it down 14% in the last year. But one thing about Enbridge, and you see their 7.7% dividend yield, so I'm not sure they're going to be able to maintain this forever, but they've had an extremely quick growing dividend here. Their dividend's grown for 28 straight years from about 25 cents a share all the way up here around $3.50 a share. And when you look at it over that 28 years, the dividend average growth rate has been 10%, which is similar to CN Rail. Phenomenal to have a double-digit dividend CAGR over decades. That's really strong value creation for shareholders, and they've benefited a ton from all these payouts of capital over the years, growing stream of income as well. So that was great to see. I was surprised to see it go back so far, and really interesting that yields got to a point that's 7.5%. So not sure if it's sustainable for it to continue to grow at a 10% pace at this point, seeing as you're getting in at a 7.5% yield on cost. But definitely really impressive track record on Enbridge over the last 25 years. And the last stock that is a Canadian dividend king is Toromont Industries, a $9 billion company, 1.5% starting yield here. Looking at this one over the longer term, let me reset that. And as I reset that, I'll go into the company here. But you can kind of see just from the range, the stock's trading right in the middle of their range here at about $111 a share. They went up to $117 on the year, down to $95, so it's been pretty stable. But over the last 5 years, this one's up big, up 66%. So over 10% a year annualized returns on capital appreciation. What do you know? Another business that is in this space of selling machinery. So you can see here their business units. They sell caterpillars, material handling. This type of business, or these types of businesses, apparently are more stable than I initially thought, and they're deriving tremendous dividend growth over the years from operating in this space. You can see here a couple things. Number one, they call out their 34 years of consecutive dividend growth, which is really awesome to see. Even though they have a small yield of 1.5%, the share price has gone up over time. So if you've owned the stock for a long time, probably have a really high yield on cost after all those increases. And secondly, love to see the return on shareholder equity in the 20s. Stocks that are really successful at growing dividends over time typically do have really good return on equity, return on invested capital, because they're using the free cash flow that they're not paying out, and they're investing it, getting 30-40% returns on it. So then they can take those returns, buy back shares, do other initiatives that naturally will increase the dividend per share for their shareholders. And me as a long-term investor, I would much rather, if I knew the company that I owned had opportunities to invest my money at a 20-25% return, I'd much rather they keep some of it, pursue those investments, instead of kick it back to me and then I have to go find a place to invest to get a 20-25% return on the markets or in other areas across the investment community. So when you have high shareholder return on equity, return on invested capital companies, it's not necessarily a bad thing that they are not returning all of the earnings to you. Going on to the last 5 years. So see here, their current dividend yield or current dividends of $1.56 a share. That's a 15% growth rate over the last 5 years. It was just 90 cents a share in 2018. So that's really great to see. And then return on shareholder equity pretty sustainably in that 20% mark, which is pretty strong as well. Looking at their earnings, expected to do about $6 a share this year and next year. So that's about 17 times earnings on this company, 18 times earnings on this company, somewhere around that you're paying for that track record of increasing the dividend 38 straight years, and for the amount of capital appreciation that they have proven to be able to create over time as we look at this one over the longer term. Really tremendous results. So I hope you guys like this content. Those were 12 Canadian Dividend Kings, self-classified Dividend Kings, I may add. Would love to hear from you in the comments if you have other ones that you would add to this list that increase their dividend every year. If there's newer companies that may not have a huge track record, but are also dividend growth companies that you own or that you're interested in, let me know in the comments. Once again, if you made it this far in the video, thank you so much for making it to the end. Not too many people do, so make sure to say hi in the comments. Give this video a big thumbs up, and if you haven't yet, please be sure to subscribe to the channel. Thanks, and I'll see you guys in the next one.